Have you ever noticed how two traders can use the exact same strategy, but one keeps winning while the other keeps losing? It's not luck. It's not the charts. It's psychology. Because in trading, your biggest opponent isn't the market, it's yourself. Fear, greed, hesitation, and overconfidence quietly shape every decision you make. And unless you learn to control them, no strategy, no indicator, and no setup will ever bring you real consistency. Today, we're going to change that. Hello traders and welcome back to the ComLucro channel. In today's chapter of our course, Technical Analysis for Day Traders from Basics to Advanced, we'll tackle one of the most important, yet often underestimated aspects of trading, trading psychology. While strategies, indicators, and market analysis are essential, the truth is that your mindset is what determines your long-term success. Trading isn't just about reading charts or spotting patterns. It's about managing emotions, staying disciplined, and making rational decisions under pressure. Most traders don't fail because they lack a strategy. They fail because of fear, greed, hesitation, or overconfidence. Mastering the psychological side of trading is what separates consistent winners from those stuck in cycles of frustration and losses. In this video, we'll explore the key mental challenges traders face, from emotional decision-making to self-discipline and risk management, and the techniques used by successful traders to build focus, control emotions, and develop consistency. And if you want to go deeper into this topic, we highly recommend our Trading Psychology course, with several dedicated modules designed to help you master the mental side of trading. So, whether you're just starting or already experienced, strengthening your trading psychology will transform the way you trade. Stay tuned, because up next, we'll explore the mental strategies that can help you trade with confidence, discipline, and consistency. Before we begin, let's address a fundamental truth. Trading is not just about charts and indicators. It's about you. Your mindset, emotions, and decisions are what truly determine your results. To help us understand this, we'll start with insights from Tom Hougaard, an experienced trader who has studied the mental struggles of traders at every level. He explains why the real challenge in trading is not technical, but psychological, and why overcoming this mindset barrier is the key to success. Let's hear what he has to say.
If there's a 50-50 chance that we could win or lose, then doesn't that mean by default that 50% of traders should be winning traders and 50% of traders should be losing traders? But the fact of the matter is that the vast majority, in the 90%, lose money over time in trading. So what you need to accept is that the odds are overwhelmingly against you, not from the market's point of view, but from a personal point of view. It's not the market that's the problem. You're the problem. And the problem that you have is that you think the wrong way. You need to think differently in order to become a good trader. And that means that you have to be kind of a Dr. Jekyll and Mr. Hyde. You have to be one person when you are out and about with family and friends, but you have to have a different mindset when you are in the market. And that mindset means that you have to accept.
As Mark Douglas once explained in an interview, much of the frustration traders feel comes from expecting something from their technical method that it simply can't deliver. He reminded us that technical systems only define and identify repeating patterns in collective human behavior. And yes, those patterns are real, appearing again and again across markets and timeframes. The real issue, he said, is that outcomes don't always align with those patterns on a trade-by-trade basis. Just because a setup looks identical to a previous one doesn't guarantee the same result. One trade might win, the next might lose, even when both look exactly the same. Later, during one of his well-known trading psychology seminars, Douglas expanded on this concept, emphasizing that there doesn't need to be a one-to-one relationship between pattern and outcome. Each trade is independent. And accepting that truth frees traders from emotional attachment to individual results. Grasping this principle is a true turning point, because once you stop trying to control every outcome, you begin thinking in probabilities and trading with genuine consistency. Now, with that foundation in place, let's move on. Up next, Dr. David Paul explains how poor risk sizing can destroy even a profitable system, and why proper risk control remains one of the hardest psychological challenges in trading.
In a 50% system, unfortunately, you get 2 bad ones every 4 trades. Ladies and gentlemen, if you were to bet 50% of your coins on any one trade, you go bankrupt every 4. Gets worse. For 8 trades in a 50% system, you have a cluster of 3 bad ones in a row. That means, ladies and gentlemen, that if you were to bet 1/3 of your coins on any one trade, you go bankrupt every 8. And most people go bankrupt because they bet far too much on any one single trade.
After understanding how mental skills shape trading performance, the next step is discipline. Having the right mindset is one thing, but without consistent structure and self-control, even the best traders can fall into destructive patterns. Many start with a clear, well-defined plan, but once emotions take over, they bend their own rules, take unnecessary risks, or chase trades that don't align with their strategy. Phil Goedeker, an experienced trader, explains why having strict rules and actually following them is the key to lasting success. He also shares the painful reality of what happens when traders break their own rules, even just a couple of times a year. In the next part, Goedeker highlights another challenge many overlook: self-accountability. Unlike a corporate job where someone oversees your actions, traders have no one but themselves to enforce discipline. He shows why failing to hold yourself accountable often leads to costly mistakes. Let's take a closer look at why discipline is what truly separates professionals from those who eventually blow up their accounts.
You know, when I was young, I grew up in a fairly strict house, always knowing right from wrong, and for the most part, always been able to decipher what I should or should not be doing. And now that I'm a parent, I realize that having and enforcing a set of rules is an extremely important part to an orderly and functional household. And any trader that wants to make it for the long haul must also have a strict set of rules and make sure we stick to them. Because at the end of the day, what good are rules, even if we break them maybe 2 to 3 times a year? You know, there's nothing worse to me personally than taking a loss in the market that can wipe out weeks or maybe even months of trading. You feel like the last several weeks or months got simply flushed down the toilet. You know, you spend day in, day out grinding out wins, grinding out trades, only to have everything, be wiped out. It can be mentally demoralizing and very hard to get your mind back on reset. You know, it's the financial part of the loss that hurts the most, but the mental and emotional part can be just as bad, because if you're not trading with a free and clear mind, you may as well go home. You know, one of the great benefits of being a trader is that we're our own boss. We work from home, and for the most part, we answer to nobody. It's really everybody's dream job. But, on the flip side, there's nobody there to hold us accountable. So let's say we all were to work for a company. It doesn't matter whether it's big or small. And 2 to 3 times a year, we bend the rules. Or 2 to 3 times a year, we just make that same mistake over and over again. And we cost this company tens of thousands or possibly hundreds of thousands of dollars. What would that company say to you? Most likely you'd be out of a job. That's why it's so important, as self-employed individuals, traders, we hold ourselves accountable for our actions. Now, as a trader, I realize the most important thing I can do on a daily basis is preserve my capital. Taking excessive risk, taking on marginal trades, or adding to losing trades is an easy way for losses to add up.
Once we understand the value of discipline and accountability, a natural question arises: what exactly deserves our discipline? Many traders assume that having a strategy with a high win rate is enough to guarantee success. But as Mark Douglas explained during one of his most well-known trading psychology seminars, trading is, above all, a game of probabilities. Even the best setups won't always deliver. The key lies in realizing that real success comes from consistency, not perfection. Douglas taught that professional traders don't rely solely on technical signals. They build what he called a trading edge. It's a structured approach designed to create a higher probability of one outcome over another. That's what transforms trading from a guessing game into a professional craft. He also reminded us that having an edge isn't enough by itself. To truly benefit from it, a trader must execute with total confidence, free from hesitation, fear, or overconfidence. That level of consistency demands a calm and disciplined mindset, one that allows you to think clearly and act objectively even when uncertainty takes over. In his words, the ultimate goal is to reach a state where you can execute your edge without emotional errors, what he called a carefree state of mind. It means learning to think in probabilities and letting go of the need to be right on every single trade. It's a powerful lesson that changes not only how we see the market, but also how we see ourselves as traders. With that foundation in place, we move to the next crucial piece of the puzzle: risk management. Even the most refined strategy won't work if you fail to manage risk effectively. Many traders enter the market with unrealistic expectations, believing they can turn a small account into a fortune overnight. Yet without proper risk control, even a winning method can lead to complete failure. To illustrate this, Al Brooks, a respected trader and educator, explains why starting small, staying disciplined, and managing losses are essential for long-term survival. Then, in an interview, professional trader Charlie Burton shared a powerful reminder about the danger of unrealistic expectations and undercapitalized accounts. Let's explore why risk management truly forms the foundation of lasting success in trading.
I think anyone starting trading is going to lose money for several years. You're looking for a career that pays a lot of money. Everyone trading wants to make a lot of money. You're competing against extremely smart people, and it's essentially a zero-sum game. So you're trying to take money from really, really smart people who are trying to take money from you. And when you start out, they're going to win. You're going to lose money. But if you have the discipline and you're careful and you learn how to be objective and you try not to be greedy, use stops, you use profit targets, I believe it's something that you can do. But I would start really small, and I would be very humble and work very hard on discipline and expect to lose for several years.
Most people are undercapitalized. They're trading with a few £100 or £1,000 in an account. If you're trying to make even 10% or 5% a month on that, it's boring because it's such a small amount of cash. And for a lot of people, they are undercapitalized.
It's amazing.
Percentage terms, it's brilliant, exactly. And that's why they have to set more realistic expectations. Too many traders out there have unrealistic expectations. They think they're going to turn 100% a month in. I literally had someone email me just a month ago who had £10,000 in an account, and he wanted to be making £10,000 a month as an income on that. It's just crazy.
In his interview, Charlie Burton explained that one of the biggest reasons traders fail is because they start with very small accounts and expect huge returns. He mentioned that many beginners try to trade with just a few hundred or £1,000 and still hope to earn 10% or even 100% a month. When those results don't come, frustration sets in, and that's when overtrading and excessive risk-taking begin. Charlie pointed out that being undercapitalized can actually be a useful lesson in patience and discipline, but only if traders approach it with realistic expectations. His message was clear: focus on steady progress, not on doubling your account overnight. That's the mindset required for long-term survival and consistent success in trading. Now that we've covered risk management and setting realistic expectations, we need to talk about one of the biggest threats to your trading success: your own emotions. Even traders who have a solid strategy and proper risk management often fall into psychological traps that lead to costly mistakes. One of the most dangerous traps is following other traders blindly instead of trusting your own system. Phil Goedeker explains why many traders fall into this habit and how it can destroy profitability. Then, Tom Hougaard will make a bold statement: Trading struggles are not technical, but psychological. He'll break down why so many traders lose money, not because they lack knowledge, but because they fail to control their emotions. Finally, we'll hear from Warren Buffett, one of the greatest investors of all time, as he explains why patience is a trader's greatest weapon. He'll show why the best opportunities come to those who wait, rather than those who feel the need to trade constantly. Let's explore how to break free from emotional mistakes and develop a disciplined, rational approach to trading.
Now, how many of us here of traders have followed a chat room, a Twitter, or a friend into an idea that we knew was not a high probability setup for our own trading style? Now, we all have different trading styles here. What works for you may not work for me. Personally, I'm a terrible long bias trader. If and when I ever do go long, I take profits extremely fast, knowing that a lot of times profits can just get away from me pretty quick. I don't have the patience nor the conviction, to hold them. That's why month after month, year after year, I personally get more strict about the trades that I place. I probably place half the amount of trades I did maybe just 5 years ago, but I make way more money. Why? Because I trade the high probability setups that I know I'm going to be profitable 80 to 90% of the time. I like to use size with those trades, and I have very strict rules when it comes to cutting losses.
If there's 100 people in here and 75 of them are losing, as it shows here on the CMC Market website, well, this is no longer a technical analysis issue. You're not a losing trader because you are deficient in MACD. And you're not running your losing positions because you don't understand stochastics or moving averages. This is not a technical analysis problem. This is a human problem. And the sooner that you accept that this is a human problem, the sooner you can actually do something about it.
Ted Williams wrote a book called The Science of Hitting. And in The Science of Hitting, he's got a diagram, shows him at the plate. And he's got the strike zone divided into 77 squares, each the size of a baseball. And he says, if I only swing at pitches in my sweet zone, which he shows there, and he has what his batting average would be, which is 400. If he had to swing at low outside pitches, but still in the strike zone, his average would be 230. He said the most important thing in hitting is waiting for the right pitch. Now, he was at a disadvantage because if the count was 0-2 or 1-2 or so on, even if that ball was down where he was only going to bat 230, he had to swing at it. In investing, there's no called strikes. People can throw any stock, and I don't have to swing. And nobody's going to call me out on called strikes. I only get a strike called if I swing at a pitch and miss. So I can wait there and look at thousands of companies day after day, and only when I see something I understand and when I like the price at which it's selling, then if I swing, if I hit it, fine. If I miss it, it's a strike. But it's an enormously advantageous game, and it's a terrible mistake to think you have to have an opinion on everything.
By now, we've covered the mental skills, discipline, risk management, and emotional traps that traders face. But there's one final piece of the puzzle: your overall mindset and how you balance trading with the rest of your life. Trading can be intense and emotionally draining, especially when you're experiencing losses or facing uncertainty. Many traders struggle because they bring their personal emotions into their trades, or they let trading consume their entire life, leading to burnout. To wrap up this chapter, we'll hear from Tom Hougaard, who explains how he developed immunity to fear, a crucial skill for making rational decisions under pressure. His insights will show that trading success is not just about knowledge and execution, but also about building the right mindset to handle stress, uncertainty, and risk. Let's dive into what it really takes to think like a professional trader and maintain a balanced approach to this demanding profession.
When I'm faced with horror situations while I'm trading, I seem to have developed an immunity to fear, which enables me to make the right decisions when they need to be made. Whether that's because I've trained or whether I was born with it, I don't know. But the fact of the matter is that my father was a vacuum cleaner repairman and mother was a nurse. So I don't think that I've come from a heritage of risk takers. So my argument is that if I can do this with a rather unique way of doing it, then I believe you can as well. But it boils down to that practice does not make perfect. Practice makes permanent. And if you carry on practicing the wrong way, you will merely establish a behavior pattern that doesn't serve you.
And that wraps up our chapter on trading psychology, one of the most crucial yet often underestimated aspects of trading. We've explored the mental challenges traders face, the importance of discipline, risk management, and how mindset separates consistent winners from those who struggle. But remember, this is just the beginning. Our course, Technical Analysis for Day Traders, from Basics to Advanced, dives even deeper into essential trading concepts. So be sure to check out the other videos in this series to continue refining your skills and strengthening your approach to the market. Please also remember that our mission here on the ComLucro channel is to give traders the clarity and confidence they need to make smarter decisions in the market. Every video, every course, and every piece of content we create has one clear purpose: to deliver practical, easy-to-apply knowledge that helps you grow step by step as a trader. Here on the channel, you'll find complete courses on smart money concepts, technical analysis for day traders, and trading psychology. Because trading isn't just about charts, it's also about mindset, discipline, and risk management. We also share lessons and insights from some of the most respected names in trading, professionals like David Paul, Alexander Elder, Tom Hougaard, Mark Douglas, Al Brooks, Larry Williams, and many others whose experience has shaped the way we understand the markets today. If you enjoyed this video and found it helpful, please give it a like. It really helps more traders discover our content. And don't forget to subscribe and turn on notifications so you never miss our latest insights and strategies. If you'd like to go even deeper and access exclusive content, early video releases, and additional tools to support your development, consider joining the ComLucro Trader community right here on YouTube. It's a simple way to support our work and a smart investment in your own growth as a trader. Thanks for watching, and I'll see you in the next video.